what happens when it's time for me to withdraw from my traditional IRA?
Well, you would have to look at what your tax rate is, and then you're going to be paying ordinary income tax on that.
On whatever you withdraw.
Do you know what happens to your retirement account in a divorce?
Is that like my Tesla stock?
Well, you might be thinking that your retirement account's going to be all yours in a divorce. Well, listen up, because it might not necessarily be.
It was my salary funding that stupid account.
Yeah, that's fair. But, we were married at the time, so...
I was not married to you, but that's okay.
Wow.
Anyway.
Whatever.
All right. So we're going to be talking about retirement accounts and divorce.
Correct.
Really fun. And strategies for cutting the cake and dividing it up.
Yeah, that's right. I think it's a great topic because people make errors on this all the time.
So much.
Yeah.
Yes.
So we're going to have some fun examples of what not to do.
Yes.
So that you can learn from other people.
And what to think about.
100%.
So we're going to talk about types of retirement accounts subject to division, because there are so many different types of retirement accounts.
Yeah,
it's
I know.
like alphabet soup. So we will go through
or number soup with that.
A lot of acronyms.
Yeah. We're also going to look at, the different methods for that division. Is it equitable? Or
is it equal?
Yeah, or is it equal?
Oh, here comes an acronym. So assessing the impact of QDROs.
Oh.
QDRO.
What is a QDRO, Joe?
Qualified Domestic Relations Order on retirement accounts. So we're going to talk about what is that acronym?
Yeah.
And how to assess that.
And why that might apply to you.
Yes.
Yeah.
So why are we talking about this? Because our own clients they didn't come to us for the divorce, so I'm going to say that part.
Yeah.
But our clients, after the fact, have told us about their divorces. And while they're telling us about how they got divided, I think for you specifically, it's like, oh, shoot, left some money on the table there.
Yeah, 100%. And yeah, like there's going to be some lessons that you can learn from this on, some considerations that you can be taking to the table when you start those negotiations, because not all the assets are going to be viewed the same way from a taxation perspective. So they shouldn't be treated equally as well.
Yeah, exactly. Yeah. So basically $100 in your savings account is not the same as $100 in your IRA.
Yeah.
But we'll talk about that. Talk about that. We have a lovely stat.
Oh,
I know that people look forward to this part every single time.
So here's one I found moments ago. So according to the National Center of Family and Marriage Research, around 30 to 50%, so a bit of a swing there, I must admit, of divorcing couples in the US have retirement accounts that need to be divided.
Okay.
So this kind of makes a retirement account one of the largest financial, considerations of a divorce. And, it does require a lot of careful sort of planning so that you don't
calculation.
Yeah. So that you don't screw it up.
Avoid tax penalties. And again, leaving money on the table because you don't realize how much it's worth or worth less.
Keeping more money in your pocket.
Yes.
Yeah, that's right.
Yeah. So let's talk about the alphabet and number soup.
Yeah. So I think hopefully you're all familiar with like something called an IRA. So that's a very common retirement account.
Individual retirement account.
And, you've also got one that's called a Roth IRA, which, has different. Should we talk about like how they're taxed differently? Let's talk
about it really quickly. Well, first of all, individual IRAs, you open these outside of your employer.
Correct.
Because it's individual.
Yeah.
So you could open it at the bank, you can open it at Fidelity, Schwab, wherever you want, basically.
Yep.
Because it's yours.
Yeah. And depending on your income level, you could either have that as a pre-tax contribution
or an after-tax.
Or after-tax. But it has a tax benefit that it goes tax deferred for you.
And the benefits are limited based on how much you make. So there's a cap, right?
Yeah.
So there's a traditional IRA. So that was the first kind of IRA that was created.
Well, it's traditional. Come on.
Okay. So that's the one that's pre-tax.
Yep.
So again, let's boil it down simply. You make $50,000 a year and you put $5,000 in your IRA. You're going to be taxed for $45,000 of income.
Yep.
Right. So you get that tax deduction for the contribution you made into your IRA. I'm not talking about maximums or anything,
no.
Just very simple calculations. A Roth IRA is after tax.
Yep. So you've already paid out all from your W-2, pay stub. You've already had all your deductions come out, and it's money that's already then hit your bank account, and then you're making that contribution to the Roth.
So taking that $50,000 that you make at your job, and you make a $5,000 Roth contribution, you're still going to pay $50,000.
Yeah.
Or the income and the taxes that you make are going to be based on $50,000 in income. But in the future, what happens? What's the difference?
Well, as long as you follow a number of criteria, it's going to be then tax-free later on. So it's a reverse of each other. One's going to be with pre-tax dollars that grows tax deferred. One's with after-tax dollars that grows tax deferred and then tax-free later on.
So assuming you're older than 59 and a half, that 5,000, right. So that 5,000 grows to 20, let's just say.
Yeah.
Okay. What happens when it's time for me to withdraw from my traditional IRA?
Well, you would have to look at what your tax rate is, and then you're going to be paying ordinary income tax on that.
On whatever you withdraw.
Correct.
From
That's
the
right.
traditional IRA.
100% of it.
Okay.
Yeah.
Whereas from the Roth, what happens?
Well, as long as you're over 59 and a half, held it for 5 years, then it's going to be tax free.
Right. So kind of nice.
Yeah. So once again,
some strategies here.
Yeah. So everyone's situation is going to be different. Work with your advisor, work with your CPA there, and they'll be able to crunch those numbers to find that sweet spot for you. Wow. That we only just covered the first one.
All
Jesus.
Right. HSA.
So that's just a health savings account. Some employers offer them. They're normally associated with a high deductible healthcare plan. And to offset, I guess, that high deductible plan, they allow you to have this account there where it is pre-tax money. It grows tax deferred for you. And then it's tax-free later.
If you use it towards health expenses.
Let me finish my sentence. Jeez. You got a habit of this, I'm telling you now. So that is like the trifecta. That's like the best one. There is a limit on how much you can put into the HSA though. Okay. Do you have one? I've still got one from an old employer.
Yeah.
And the benefit of the HSA is if it's over a certain balance, it actually gets to be invested as well.
Okay.
Yeah. So then you've got, if you work for a big employer or company, in some states
Not
are
even
actually
big.
some
Small,
companies,
medium, large.
like in some states, they're actually having requirements now. If you've only got a few employees, that you've got to be able to offer an employer plan. So typical ones that we would see would be a 401k, or if you're in the nonprofit sector, some 403bs or education. There's a 457, a 401a. There's that little alphabet soup and number soup.
Right.
Yeah. So what are those ones, Joe?
So those are typically, well, they have traditionally been pre-tax, but some employers that are bigger can often afford to have both, right? Roth, 401k or 403b, and a traditional one.
Yep.
So again, we are talking about divorce in this case, but if you're just trying to strategize, like, do I contribute to this one or that one? You may want to reach out for some help.
One of the big benefits of a 401k or a 403b is you've got a lot higher contribution amounts that you can make into that retirement account than just your traditional IRA there. Yeah.
We're going to keep this high level, but there are qualified and non-qualified plans.
Good luck on keeping this one simple then. Okay.
So non-qualified plans aren't required to follow a domestic relation order, technically.
That's that QDRO that you mentioned earlier.
Yes.
So the plan administrator can say no to it,
yeah,
correct?
Can say, I don't need to follow this.
Yeah.
So that would be interesting.
Yeah.
But most of them do, I would say. It's their option not to.
Yeah.
All right. So for you self-employed folks or business owners, there are other IRAs called a SEP. SEP IRA that is different from your traditional or Roth. So that is a simplified employer plan. Typically a one-person plan. Maybe there's a handful of people that could have the SEP IRA within a company, but typically I see it with solo business owners.
Yeah, it's got similar sort of contribution limits. Don't quote me on them as like a 401k, but without some of the
sometimes higher.
Without some of the filing and additional costs of a sole 401k.
Right.
Yeah.
There's also something called a simple IRA.
Yeah.
And a KEO. So just suffice to say that's for small business owners typically, or like a doctor's practice, dental practice, stuff like that.
Something that coming I guess, less common, but they still, some of the employers out there do offer it, is a defined benefit plan, or what I would normally just call a pension, where it's like guaranteed income for life based off years of service, age, and as well as income.
So typically we see that nowadays only for people that have worked at the same employer for 20 years or something.
Yeah. But that is a big part of trying to break down those numbers and calculating, and why you do need to work with a professional to, come up with what's that split though, correct?
That calculation.
Yeah.
So there is a way to calculate it. I would say I don't know. Maybe you could Google it, but I feel like it's not that simple.
It's not back of the napkin sort of stuff though, is it though?
No.
Yeah. So
what's up for grabs?
Yeah. Well, it could be really 50-50 or equitable, depending on your state. Do you look at, the years of marriage that you were actually married there together, and like look at the contributions that you made?
I don't know that it matters what you contributed. It's when you were married and when you contributed it.
Yeah.
So even though theoretically I made all the contributions, it doesn't matter.
Yeah. If you were married,
that balance has to be split.
If you were married during, so we're going to look at, when you work with a professional, they're going to look at like contributions that you made before marriage, as well as post-marriage.
Yeah. So back to that pension, it gets really complicated for people like teachers, for example, that had been working as a teacher since they were 22 and contributing to that pension, or the employer was contributing to that pension on their behalf. And then they got married at 31.
Yep.
And then they were together for 12 years or whatever. Right. So someone has to calculate how much is that pension worth from age 22 to 31.
Yeah. With appreciation.
Yep. But that part is separate from what needs to be divided.
Yeah.
And same with all the other alphabet soups. So the IRAs and 401ks and all that stuff. If you contributed before marriage and you can trace it back, that money and the growth is yours to keep and not divide.
Yeah. Another thing that you also got to look at is how it's taxed as well. So you've got the pre-tax and then the post-tax retirement accounts too. So what I'm talking about there is even just in the simple things of like a 401k versus a Roth 401k, they're not equal. You cannot go like 100,000 of a 401k is equal to 100,000 in a Roth.
Yeah. It's not the same. The Roth is more valuable.
100%. Yeah.
Within that example.
Yeah.
Because for the traditional 401k or IRA, you have to pay taxes, remember, when you make the withdrawal. So the 100,000 is not 100,000. Depending on your tax rate, it could be 70,000, be 80,000, but it's not 100.
Yeah.
Whereas 100,000 Roth is 100,000.
I've had a client who, and I've mentioned this probably on a previous podcast I have, where they came down to dividing of retirement accounts, and I'm just going to use, it was 100,000 in a traditional IRA and 100,000 in a Roth. And they viewed those as equal, even though the person who got to keep the Roth was a high income earner who was not eligible for a Roth, who could not contribute to a Roth, self-employed. So I guess he could have set up his own, but it would have taken him multiple years, and the amount was higher. I think it was like around 300,000.
Basically, it was to his advantage.
Yeah, it was to his advantage. If you had just scheduled like a little bit of time with a professional, that answer would have been flushed out. And that had a huge ramification there. And it's too late now,
Right. So your client ended up with less because they ended up with the, in this example, $100,000 pre-tax amount, which will get taxed at some point and not be 100,000.
Yeah, they viewed it, both retirement accounts, as being this equal.
Right.
Yeah, correct.
So in terms of figuring out what to divide and what happens, it's important to note that transferring a spousal interest in a retirement plan. So we decided that the 401k is going to get divided, even though I'm working at Amazon and it's my Amazon 401k.
And you're still going to keep on working at Amazon.
And I'm going to keep working at Amazon, but part of the 401k is going to go to you, let's say.
Correct.
That is that has no tax ramifications to it. It'll just change names. Like they'll have to create a 401k for you. Correct.
Yeah, there's a way that you can kind of peel out, in Joe's example there, my segment of that 401k, and it can be a non-taxable event there. But you do have a short period of time though as well. So there's all these little laws and timings, I guess, that you've got to be mindful of, so that you don't screw it up. Yeah.
So there's a special, and I didn't know this when I got divorced. I learned this from being a CDFA. There's this special benefit, I guess, that's different if you're taking from an employer plan. So 401k, 403b, 457, the numbers, the numbers versus an IRA. So let's say we divided up a 401k and I needed money. The recipient of the other person's 401k can take money out one time or for a short period of time without that 10% tax penalty if you're underage or younger than 59 and a half.
Yeah.
Whereas if we divided up an IRA and I gave that to you and you took from the IRA, you would get dinged for not being 59.
Which is important consideration when you're starting to work on your new budget and those new goals. Like, do I need to take a little bit of extra money out now to get myself grounded and up my feet? That could be the opportunity to take it from that qualified account there.
And let's just say both of you sort of agree that really you're just going to make this equal. I mean, there's really some strategies there if you two are trying to be amicable.
Yep.
Where if you're just going to try to help the other person out because you know that they need to take some money out or they're trying to help you out, they can allocate part of their current 401k to you so that you're able to take that one-time withdrawal. And then you can just kind of pay them back by giving them the equal amount in the IRA, in one of your IRAs, so that it's a net zero.
Yeah.
If for example, you two have decided to keep your own retirement accounts, but you're still helping each other out in a way with this benefit that I would say is not well known.
Yeah. And so when you look at, division of like this, a simple, like a normal IRA, though, there's different ways that you can do it too. Correct. So you can just change the owner on an IRA. You can also, do a trustee to trustee. You can do a rollover. And that alphabet soup earlier that Joe mentioned called a QDRO, it doesn't apply to an IRA, correct,
You
Joe?
don't need that. Yeah. And a QDRO is actually an extra document that you have to pay for post-divorce.
Correct, yeah. Someone needs to draft that up. Yeah.
So if you can avoid that, that's nice. But a QDRO most likely is needed for, I would say, most employer plans.
Well, you say avoid it, but you'd want to calculate it whether or not you're not being screwed out by not doing it.
Right. Yeah. It doesn't cost as much as a divorce. It costs, I would say, a few $100s.
Still run your numbers to make sure, if you're entitled to some of those assets there. Yeah.
Of course.
Just want to make sure you're not saying that there.
No, there's no reason to avoid the QDRO, but if you two just have a million IRAs between you, a QDRO is not necessary.
So that kind of brings us to that last item that we wanted to touch on, the QDRO. So what is that again?
Qualified Domestic Relations Order.
And so, so what is that though? It's a judgment, correct?
Yeah. So it's a legal document that tells the, what do you call them? The retirement plan administrator, whoever's running your 401k or 403b, it gives them instructions on how to divide that account.
Yeah. So it's a judgment or a decree or an order that creates or recognizes an alternate payee's rights, correct?
Yeah. And it's very specific to the 401k. So it's not the divorce decree. It's really only for the pension or only for the 401k plan.
That's right.
Yep.
And so these are, I guess, plans that are ruled by something called ERISA or qualified retirement plans, as Joe mentioned there. Don't quote me on what ERISA stands for again.
We don't need to get into ERISA now.
So it's issued by a state court typically, and it's signed by a judge. And it then, as Joe mentioned, I think earlier there, that it needs to be
approved by the plan administrator.
Correct,
Yeah.
And is it a pretty quick turnaround time? I can't recall.
I mean, the person I used was super quick.
Okay.
You don't necessarily need a lawyer for this. There are people called QDRO specialists that, again, charge a few $100s as long as your divorce decree is really clear, like what you're entitled to. That those specific pages from the divorce decree can be sent to the QDRO specialist to write up this document that will be sent to the retirement plan administrator.
So just remember, so that not IRAs aren't subjected to the QDROs, as well as some of the, smaller plans.
Non-qualified plans.
Yeah, as well as many of the public employee plans. So like police, fire, city, state, and government employees, some federal as well there, might not be subjected to that QDRO.
And when in doubt, you can go to your HR or 401k plan administrator, 403b, and just say, do I need a QDRO or not?
Yeah, that will know.
Don't even think about it. Just ask.
Yeah.
And they'll say yes or no.
Yeah. People people just go, I'm just going to QDRO that, don't they? So, yeah.
I don't know.
Yeah, I think so. And like we mentioned earlier as well, it doesn't have to be split 50-50. It can be a different sort of division.
Right.
Yeah.
It's just whatever you two agree on.
So in your role as a CDFA, do you do QDROs for people? Or
I do not do the QDRO. I can do the calculation on how to divide up, let's say, the pension or the retirement plan. So looking at all the assets, whether they're retirement or not, and helping the couple or the individual figure out how to divide it.
Because the QDRO is just like that document, though. That
document just for one or two specific plans, probably.
Yeah.
Like between the couple.
Anything else that we want to kind of cover there?
I feel like it was like Sesame Street. Like we talked about a lot of letters and numbers. Yeah. Sorry that we didn't do any singing.
But it definitely is an important topic. You don't want to screw it up. You need to get it, know what you're entitled to, because it's going to have huge ramifications if you screw it up.
And honestly, out of all of that, if you only have one thing to remember, just know pre-tax and post-tax, two different amounts.
Yeah.
$100,000 IRA and $100,000 Roth, not the same.
No.
Just remember that part.
Call BS on
Yes.
I think we've come to the time where we're going to be doing a bit of divorce, this and that, yeah?
Yeah.
So what have we got?
All right. So which one would you choose? Would you prefer to retire early, but you have to live in a retirement home, or you'd have to work till 75, but then you can live independently?
That's an easy one. I'd work to 75. Wait, am I still doing the same job? Yeah.
Define it however you want.
Yeah. So I love what I get to do. I love getting to work with clients. So I'd happy work to age 75 because I'd still have vacation. I don't see the appeal of a retirement village or home. I find them depressing.
Okay.
So for me, I'd work longer and really enjoy that life there.
All right. So for me, I'm the opposite.
Oh, you are?
Well, I'm going to define it.
Okay. All right.
Okay.
Give me some color.
Yeah. So did you ever watch that Cameron Diaz movie where she went to live with her grandma at this retirement community in Florida that was kind of like a beach resort?
No, I don't think I did. No.
So I would prefer to retire earlier, but I want to be in like a really swanky retirement community / resort where they're cooking chef's meals for me and I can get my nails done downstairs and I'm going to relax by the pool. And they have shuttle services to, wherever I want to go and hang out.
Whatever show's playing, yeah.
I'm going to go to the bar downstairs with my girlfriends. We're going to hit on the one dude that lives at the retirement community.
That's still alive.
Yeah.
Right.
So.
All right, okay.
Yeah. I think that would be fun.
Enjoy that. So
I will, thank you, because I'm going to retire earlier.
Yeah.
So. Anywho.
Well, I thought you would have actually gone the other way there. So guess not.
I want to live at the resort.
If you recall, we spoke on this episode about, retirement accounts and, how to divide them or the division of those.
Yes.
We spoke about different types of retirement accounts.
Lots of different types.
Yeah.
Lots of different types.
And then we also touched on, I guess, the methods of how do we split those assets.
Potentially splitting them and what to think about when splitting them.
And the big one on that, not all retirement accounts are the same.
Right. And then we talked about QDROs a lot. Yeah. So QDROs with pensions or employer plans.
Correct.
So maybe this one you need to listen to twice. Right?
Or a third time.
Or a third time.
Or reach out
with questions.
Yeah.
Reach out with questions. So I'm Joe.
And I'm Jane. And this is another episode of Cover Your Assets. Hope you got some value out of it.
We'll see you in 2 weeks.
Yep.